Namaskar and a very good evening to one and all. I, CA Deepak Chopra, Chairman Direct Tax Committee of Karnataka State Chartered Accountant Association, welcome you all to part 2 of today's session on tax audits. In our previous sessions, we have gone through the various amendments under law relevant for trust audit as well as audit under Section 44AB of the Act. Those who could not attend the earlier sessions can see a recording of the session on YouTube. Please do visit and subscribe to KSCA's channel on YouTube. Today, to deliberate on recent case laws relevant to current year's tax audit, we have with us CA Shri Narendra Jain. On behalf of entire team KSCA and participants for today's session, I extend a hearty welcome to you, sir. A quick introduction of sir before we hand over the proceedings to sir. Sir is a commerce graduate and FCA. He is also company secretary and holds a bachelor's degree in law. He has experience of over 18 years in advising clients and handling tax litigation in income tax, transfer pricing, corporate tax, international taxation, and GST. His academic distinctions include All India 5th rank in CS Center, DL Mazumdar Silver Medal for securing highest marks in Advanced Company Law in CS Final, Taxman's Prize Award for securing highest marks in Direct and Indirect Taxation, CS Final, Mrs. Pankajan Rengachari SIRC Prize Award for securing highest marks in Advanced Company Law and Practice in CS Final. He has co-authored following books: authored book Analysis of Transfer Pricing Judgments published by CCH, 2 editions; co-authored book on digital commerce and analysis of taxation aspects and emerging issues published by IFA Bangalore subchapter; co-authored book Permanent Establishment Emerging Trends published by CTC and Taxman; co-authored book New Age Assessment Penalties and Appeals published by KSCAA. He is regular speaker at various conferences, workshops, study circles, etc. His teaching stints include teaching for CA final students at CAPS and for CA final students at ICAI Bangalore branch. Sir was convener at Bangalore subgroup of Chamber of Tax Consultants Mumbai for 1920 and treasurer of International Fiscal Association Bangalore subchapter for 18 to 2020. He is currently joint secretary of Bangalore ITAD Bar Association. With this very brief introduction, sir, over to you.
Thank you, Deepak. Good evening, everyone. Let's share the screen. I hope the screen is visible.
Yes, sir.
And my video is also visible, I hope.
Yes, sir.
Yeah. So for next 1.5 hours, we'll try and analyze certain interesting decisions on relevant to the tax audit, relevant to from the perspective of tax audit and from the perspective of the screen is visible, right? Because it just disappeared from my.
You can try resharing, sir. We can see it, but it is in a very small size.
Okay, I'll reshare it.
This is visible, sir.
Okay. There is some difficulty at my end. Let me, I think, redo it. Is it visible now?
No, sir.
Okay. It should be. It
Uh,
should.
it, no, it is visible now, sir. It is visible, yes.
Yes. So what we'll try and do in next 1.5 hours is try and look at certain recent decisions and then try and analyze the concept revolving those decision, involving those decision, which could be relevant from a tax audit perspective. Try and cover say 4 to 5 concepts which are relevant from the tax audit perspective, and what could be the decision. So if we start, what I have planned is we'll start from some recent decisions and then try and analyze the entire subject around that decision. So sometimes the decisions, as we generally try and see, are aggressive, but when we do tax audit, when we try and say that these are more for defense perspective, that when an issue comes up in an assessment or appeal, we try and use that such propositions of law. But there could be situations that we may not want to use those propositions at a stage of audit or at the stage of advising a client. So there could be some of these decisions, the principles of which we may sometimes not agree with. I will try and place those decisions and my views on those decisions also, and every professional can make his own judgment as to how to use them for their purposes. We'll start with the issue of TDS. TDS itself has become a very critical issue in terms of tax audit. It is a very large and critical component of the tax audit currently because of, also the quantum of work involved in one of the important areas of the tax audit. As we have seen over the years, the number of sections for which and number of payments for which TDS is applicable has increased drastically, and thereby naturally the amount of reporting that is required has also increased drastically. Every year we find a couple of new additions made to TDS provisions, and that is where the challenge keeps on increasing in terms of tax audit also. Though I'm not looking at individual sections, but one very interesting issue is TDS on year-end provisions. This becomes very important aspect of audit also because provisions have to be made. Today, assessees majorly follow mercantile system of accounting, and in the mercantile system of accounting, applying the accrual principles, we need to match, also applying the matching concept, we need to have the expenses accounted in our books, a provision for expenses made in our books. So this becomes very necessary because so this becomes very necessary. So when we look at the provisions, they raise two challenges. One is whether the provision itself is a deductible expenditure. So how do I report whether in 37 it is allowable expenditure? Is it an unascertained liability? This also has implication for tax audit. And then the TDS on it. As we all know, the TDS disallowance provision in clause 21B expects the tax auditor to report whether there is any shortage in terms of deduction of TDS or TDS is not deducted and quantify what needs to be disallowed. Also, as we all know, clause 34, clauses A, B, C, dealing with the entire gamut of reporting, that how do we, what is the TDS, gross amounts, net amounts, what is on, what rate TDS is deducted. Then you have whether the statements are filed correctly or not, and 201 proceedings. So TDS on year-end provisions also may have implication in 201 proceedings. No doubt, clause 34C only expect us to report interest, 201(1)(a), but that also may arise in certain cases where this provision issues are there. So keeping that in perspective, we need to be aware of this particular issue of TDS on year-end provisions. And these are connected issues because, say, for example, you report something in 40B, 40 clause with respect to disallowance, not 40B, 21B, 40A. So if someone is disallowing that there is a disallowance of expenditure for not deducting TDS, the issue doesn't stop there. In all probability, the issue goes up in 201 proceedings, as we have seen in certain cases in Bangalore Tribunal, like IBM case, Biocan case, where the assessee suo motu made a disallowance under 40A clause 1 or clause 1A, and then the 201 proceedings were started, saying that you yourselves have made disallowance, therefore I am starting a 201 proceedings. So these are all connected issues which we have to keep it in mind, that reporting at one place can naturally lead to multiple implications. So as I said, TDS on year-end provisions, two aspects we have to keep it in mind. When do we say that it is a provision which is a deductible expenditure? Second, when do we say provision there is a liability to deduct TDS? The challenge necessarily arises because of the explanation to most of the sections of TDS, which provides, as we all know, the TDS liability is on payment or credit, whichever is earlier. So payment, all it is but natural that if I made a payment, then it will not be coming as a provision in my books of account as a liability. But there could be situations where I will either credit to account and not make a provision. That in any way will be a liability, and it is credited to a respective account. So TDS liability will anyway arise in those cases. Now, when the credit is made to a provision account, whether the explanation will be attracted or not becomes an issue for us to debate. Because the way the explanation is being worded, it says credit has been made to suspense account or any other account. So what do you mean by any other account? Does it mean that the credit to a provision account is also sufficient for the explanation to be attracted? Has been one of the issues which has been hotly debated. So this is what we have to keep it in mind as we go forward. Now, why does this provision arise at all, and what are different kinds of provision, and what are the defenses the assessors have been taking while the matters have come up before the courts, saying that whether the TDS on year-end provisions are applicable or not? So basically, if you look at provision as we traditionally know it, there could be expenses which the assessee has to accrue. So for example, a simple example is an audit fees. So I have to accrue the audit fees. Say I have to pay so and so chartered accountant for so and so professional service in terms of the audit, statutory audit, tax audit, whatever audit it could be. So there's a liability for that audit which needs to be accrued. Now here the pay is broadly known, the recipient of income is broadly known, right? Now there could be a situation the quantification is also known in most of the cases, but there could be a small variation because of the nature of service or quantum of service. So you have a situation where the pay is known, the quantum is also known, there could be a small variations. If we go further, then there could be variation to these particular situations. For example, a large company like Infosys or TCS or Wipro may have a transport service provider. Now here the pay, there may be 4 or 5 vendors who provide the services, saying that we will take ferry your employees from different part of Bangalore and come to the office location. So there is a service provider who has provided service in the March. Now as per the contract of service, the liability to pay may arise on 10th of April, say subsequent month. The liability to pay may also arise subsequently. Further, the quantification is also not clear on the 31st of March. The quantification may happen subsequently because it may depend on various factors like how much kilometers the vehicles have run, right? So these aspects can lead to a situation where the pay is known, the services are identified. So it is ascertained that the services are rendered in the month of March. The quantification may be delayed. So the invoice may really come, say, on 30th April. Now, given the modern day practices, many of them close their accounts very quickly. Some of them may even be closing by April 15, April 20, April 30. Now, when you close the account so quickly, there is a chances that the invoices may not be received for these services. The invoices, say, for this conveyance service contractor, conveyance contractor may not be, transport contractor may not be available if I close the account on 20th of April and he gives me a bill after that. So the exact amount of service that he has rendered, the amount for which I have to pay to him may not be available at the date of closing the account. So now the provision is made in the books of account based on, say, historical basis, that this is the every month I am receiving this bill, and this is how I am making the provision for on that estimate basis, on a historical basis, or some other scientific basis. Now there could be many such examples one can give that the provision may come into picture. Now, if you see this kind of a provisions, the pays are known, but the quantum of the amount is still not known. You are not very sure. In audit fee, one would be still having a broad outline that this is the fees I'm going to pay, and the fees might be agreed in advance. But though in a transport service provider, the fees may not be identified in advance. So you might have said that per kilometer I'm going to pay this, but how much the really that kilometer is there, once the bill comes and it is approved and cleared by the admin department of the company, only then I will get to know. So this could be a second time of provision which can come into picture. So I make a provision entry on 31st March that this is the amount I'm going to pay. This is the estimated amount of the conveyance charges. There could be further changes in this particular kind of provision. Is one, that the payees are not identified. For example, take the classic case of IDBI's case. Is a reported decision in IDBI's case reported in 107 ITD 45. Now, interest accrued but not due. So the due date of interest payment may be on 30th, say June, and the cutoff date may be the people who are on register of those bonds or debentures, etc., or securities on 30th of June. On 30th of June. So there may be two payment dates, for example, 31st December and 30th of June. 31st December I paid accounted, but the next payment date is 30th June, and the cutoff date for those is the bond holders or debenture holders on that 30th of June in my register of bonds. So at that point of time, I will know who the payee is, because 31st March the payee may be X and he may sell that bond in an open market in April or May or June, and the new holder may come Y. And when I make the payment in June or July, that time I have to make the payment to Y, and the TDS liability will be on the Y. So therefore here the amount is known that this is the interest for 3 months, but the payees are not known. Payees are unidentified. Now for the TDS to attract, the classical system TDS to attract is where the payer and payee especially is identified. There is a payer, he is making a payment, and the payees are identified. You know to whom the TDS has to be deducted. This is but obvious, because only the credit can be then given if the payees are identified. If the payees are not identified, the credit for TDS cannot be given to the payees. So the Mumbai Tribunal in IDBI's decision held that if the payees are not identified, the TDS obligations do not attract. The TDS obligations do not attract. So now this was a different kind of provision which was there. Other challenges which arose has the system moved forward is the assessees have very different practices. The original system of provision was I make a provision, say for example, audit fees on 31st of March, and I get a bill in June. So I move that, pass an entry in June of that bill in the provision account and do not reverse the provision. But over the years, there is a monthly provision which are reversed on every month or first of the subsequent month because of some MIS reporting requirement. There are quarterly provisions made which are reversed, and there are yearly provision made which are years. So there's a large practice that you make a provision on 31st of March and you suddenly reverse it on 1st of April. So what happens to these cases? What the TDS obligations will be there? Whether these expenses will be deductible? So this is the gamut. This is just a background of the issues. This is the issues that arises from a tax audit perspective, tax computation perspective. So first, let us look at the TDS angle. So the issue was in the case of Subax, a recent decision of Karnataka High Court. The issue in this was assessee was following the mercantile system of accounting. The assessing officer, what the provision was made, the assessing officer had disallowed the payment under 40A 1A, clause 1A. The assessee follows mercantile system of accounting. So assessee incurs various expenses in connection with the services rendered. The invoices are not received up to 31st March of a relevant year. Now, the year-end provisions are estimated basis. The assessee had submitted that the actual amount can vary, the actual invoice can vary from the estimated basis. This is one of the main arguments, that the payees are not identified in respect of these parties. The assessee don't know who are the parties. Then this is reversed on first day of next year. And subsequently, when the invoices are received, the party account is credited and TDS is done at that time. So EO said that on provision TDS should be done. He disallowed the amount, which was upheld by the tribunal, Bangalore tribunal. Now, the matter moved to the High Court. There, in the High Court, the assessee argued on various aspects. One, the assessee argued that the payees are not identified. The payees are not identified. The provision is reversed on next day, that is the 1st April, and as and when the payment is done, the TDS has been made and no liability, no revenue loss to the government. The Karnataka High Court relied on its earlier decision in KPTCL, Karnataka Power Transmission Corporation Limited, 383 ITR 59. Now, there the decision was that if the income attributable to pay, if there is no income attributable to pay, there is no liability to deduct tax at source in the hands of tax deductor. And therefore, there is no liability to deduct tax. So the question of disallowance does not arise. The KPTCL was in the context of 201. Now, if you see, the associate has taken three main arguments. One, the payees are not identified. There is no income accrued in the hands of the recipient. Third, the amount of provision is reversed on 1st of April, and subsequently, when the payment has been made, the payment has been made and TDS has been done at that particular point of time. The Karnataka High Court has accepted these arguments and held that there is no liability to deduct TDS in such cases. No liability to deduct TDS in such cases. Now, the revenue had relied on the decision of Palam Gas Services. I don't know why they relied on this particular decision. This is nowhere relevant to the issue of year-end provisions, 394 ITR 300. The issue in Palam Gas was whether the TDS provisions of disallowance provisions under 40A 1A are applicable to year-end liabilities only, or for the payments which are made before that, whether the liability of disallowance also applicable. So that was the issue which was held in revenue's favor in the decision of Palam Gas. But anyways, the High Court even distinguished this decision, held that in the case of Palam Gas, the payees were identified, and whereas in the case on hand, in Subek's case, payees are not identified. There is no dispute that payees are not identified. Revenue has not disputed that particular aspect. Therefore, they allowed it. There are another two decisions of Karnataka High Court, Toyota Kirloskar Motors and Volvo Motors. In these two decisions also, they have gone by the same arguments and held that the year-end provisions, TDS, are not applicable. Year-end provisions, TDS, are not applicable. Let's look at some other decisions and then we'll try to draw the conclusion on this particular issue. Next issue is the Gujarat High Court, very brief decision, does not discuss the issue in very detail. A Sangi Infrastructures case. The Gujarat High Court held that, again here they held that the bills were not received for the year under consideration and 40A 1A disallowance could not be made. In the case of HT Mobile, this is a Delhi tribunal decision. They went by the fact that it is reversed on the first day of the subsequent years and payee identification is not there. As you see, these are the same arguments coming on. Interestingly, the tribunal relied on two decisions, UCO Bank's decision and the Ericsson's decisions. Again, these decisions are in different contrasts. The Ericsson's decision was there is a royalty payment which was to be made to the foreign related party of Ericsson. However, due to FDI regulations, they could not make this payment. So when the provision was made, subsequently it was reversed because the FDI regulations did not permit the payment of such royalty. Now, in that context, the income did not accrue to the non-resident and they said that it is not liable for TDS. In the case of UCO Bank, the interest was on FD, fixed deposits, but that was paid to the High Court Registry. Now, High Court Registry had directed UCO Bank to make certain fixed deposits on the behalf of certain litigants. Now, the payment was made to High Court Registry. Now, High Court Registry cannot be treated as payee. So they said that payee is not, there is no existence payee here because High Court Registry cannot be treated as payee and therefore there is no liability to deduct TDS. This was the view which was canvassed in UCO Bank's decision, right? So, but anyway, the Delhi Tribunal and HT Mobile followed these decisions and came to a conclusion TDS is not applicable. Now, HDFC Sales Limited also took a similar view. It did not follow the decisions of Hardik Jigneshbhai Desai and Abad Builders and distinguished them on the ground that in those cases the recipient was identifiable. Therefore, this was not there. The interesting decision also of Bosco Limited in the of the Bangalore Tribunal, where the tribunal went on the ground that the income does not arose to the payee. There is no accrual of income in the hands of payee, and therefore there is no liability to deduct TDS. There is no accrual in the hands of payee. Therefore, there is no liability to debtors. Please understand this also, because see, in the context of 194C or 194J or these decisions, the liability to deduct TDS has been cast. The timing is when there is a credit or payment, whichever is earlier. Contrast this with section 195. In case of 195, the liability is only arises if the income is chargeable to tax. Now, income should be chargeable to tax in the hands of non-resident. So, therefore, in context of 195, accrual of income becomes very relevant. But whether the same is relevant for other sections is a doubtful proposition. As I said in the beginning, some decisions could have gone, but the proposition of law that they're laying down may not be proper. In my opinion, the contention that the income does not accrue to in the hands of payee can be taken for if it is in the context of 195. But when it comes to the cases like 194C or J or these cases, in those cases, to say that the liability to TDS is on the accrual of income in the hands of payee may not be proper. The decisions of KPTCL is a favorable decision. Someone can take a benefit of that, but whether it is a correct proposition of law is doubtful in my humble submissions. Now, why they have taken this view is the TDS is a vicarious liability. The primary liability, it is a secondary liability. The primary liability under section 4.1 is of the recipient of income. Under 190 is of the recipient of income, because if I don't deduct TDS, there is still a right to recover the tax from the recipient of income. So going by that understanding of provisions, the courts have taken a view that because it's only a secondary liability, if there is no primary liability, question of secondary liability, question of vicarious liability of TDS does not arise. However, the language of section would not possibly support this proposition. But anyway, that is how the decisions are there. Then we come to certain interesting contrary decisions. And when we see this contrary decision, and then we can summarize the entire proposition that what could be the proper proposition of law that we can follow in our regular practice. Now, in this particular case, the IBM's case, IBM India Private Limited, this particular case and the next case where we will discuss, Biocon's case, these both cases are in the context of section 201. Now, in this case, what had happened is the assessee suo motu made a disallowance in the tax audit report under clause 40A1 and clause for section 40A1A, clause 21B. So assessee suo motu himself made a disallowance saying that these are the provisions and TDS has not been deducted. Therefore, I am making a disallowance. The assessing officer, based on such disclosures in the tax audit report, issues a notice under 201. And based on 201 proceedings, comes to a conclusion that on the year-end provisions, the TDS is applicable. Before the CIT confirms that view, and CIT also in a detailed order writes that the assessee's contention, before the CIT appeals, the assessee argued that payees cannot be identified. These are just provision entries. Therefore, there is no liability to deduct TDS. The assessee, this was not accepted by the CIT appeals. The CIT said that the assessee should demonstrate that payees cannot be identified. You can't make a bald statement that the provision is made on some historical basis, some scientific basis, some estimate basis. The assessee should demonstrate how the provision has been made and how it has come to that. The assessee has not demonstrated this, and therefore the contention that payees are not identified has been rejected in this particular cases. This view of CIT Commissioner Appeals was accepted by the tribunal to hold that in this particular case, the assessee's contention that payees are not fully aware, assessee is not fully aware of the payees, cannot be accepted. So this contention was rejected by the tribunal. That's the starting point of this decision, that payees not identified the argument was rejected. When we see the earlier decisions, they have gone by the statement that payees have not identified, therefore TDS provision is not applicable. Right now, let's try to understand this concept of payees in slightly detail here, because then they will be able to reconcile the decision of IBM with other decisions. Now, I gave an example of transport contractor. I gave an example of IDBI's case. Now, IDBI's case, there's a very clear-cut understanding that payees are not identified. But when I make a provision, to say that payees are not identified, is not that easy for each and every expense. There could be classes, certain expenses for which pays may not be identified, for example, interest accrued but not due. But there similarly will be cases where pays are easily identified, like an audit expense or transport contractor, because with them one would have entered into an agreement that this is the service he is going to provide. Only the quantification may not happen on 31st of March, and therefore I would have passed a provision entry. And it is subsequent that the assessee will be really knowing what is the quantum of amount. But when I make a provision entry on 31st, I know the quantum, I may be knowing broadly who the payers are. Another challenge happens when there are multiple contractors. I may know the names of contractors, but what could be against each of the persons, I may not be aware of these particular cases. If I say that pays are not identified, as we've seen the subsequent decision of Interglobe Aviations, the tribunal says that if the pays are not identified, how is it an ascertained liability? Is it not an unascertained liability if you say that pays are not identified and I have made a provision on estimated basis? So the name of the person is not identified, the amount is on estimated basis. So how is it a deductible expenditure itself? So when we make this argument that pays are not identified for year-end provisions, we'll have to be careful that we do not attract section 37 disallowance itself for it to be classified as an unascertained liability. And therefore, when we go and support the argument that they are ascertained liability, naturally one will come back and say that these are the services, these are the people who have rendered services, and this is the estimate. Therefore, my claim of them being an ascertained service is valid, and therefore this is a deductible expenditure. These both will stand on separate and opposite situations, opposite footings. So for claiming that it is an ascertained liability, I'll have to naturally support with basis that this is how the liability has been quantified, provision has been quantified. When it's come to TDS, I will have to argue that the pays are not identified. No doubt there are other arguments like them reversing the expenses and other things, but just try to understand this, that these both will stand on an exactly opposite footings, and one will have to be careful when he makes this argument that pays are not identified or the provision is an ad hoc provisions. Those may also invite a risk of disallowance of such an expenditure. Right? Coming back to IBM's case, so the tribunal held that pays are identified. Next, the tribunal held that the tax credit to the provision account is covered in the explanation, and because the explanation talks of suspense account or any other account by whatever name called, it would include a provision account. Therefore, they held that it is covered within the explanation. Third, the associate submitted that subsequently when the payment made, I have deducted TDS. So I made a provision in March, the bill came in say July, August, September or December. At that point of time, I made the payment of TDS, and therefore I cannot be assessed in default. This argument of the assessee was accepted. They said that once the TDS has been subsequently done, the provision of 2011 will not be attracted. So assessee cannot be treated in default to the extent of TDS has been deducted. However, when it came to interest under 2011 capital A on account of delay, the liability was upheld by the tribunal, and tribunal concluded that from March to the date of actual TDS, the liability for deducting TDS will arise. Liability for deducting TDS will be arise. The assessee had also argued that there are certain non-resident payments, and therefore the income does not accrue in the hands of such non-resident, which is the basic condition of section 195 to be attracted. The tribunal rejected that argument on the ground that the assessee has not provided those basic details to demonstrate that income is not chargeable to tax. Right? And for other section, they concluded that the accrual of income is not relevant. Now, assessee also argued in this particular case that, look, I have already made a 48 disallowance. Beyond that, do not make a 201 assessment again. The tribunal concluded that 201 and 48 disallowance are separate proceedings. A same default may attract two different proceedings. It may also attract a penal proceedings. That is also held in the subsequent decision of Biocon. These two are separate and independent proceedings. These are not connected proceedings, right? And when the assessee himself has done a disallowance under 40A, clause 1 or clause 1A, in those cases, the assessee then cannot come back and argue for 201 purposes that there is no liability to deduct TDS, because both the issues or both the consequences spring out from the same default. Therefore, both are connected matters. Both are connected matters. One can also then refer to Biocon's decision, similar reasoning, but a very detailed decision, very detailed discussion on this particular subject, covering all aspects of this particular issue and trying to lay down principles on laws, these particular issues. It also accepted that if payees are not identified, the assessee will have to prove. The responsibility to prove that the payees are not identified is on the assessee with credible reasons. So assessee should come and demonstrate that the payees are not identified. Then we have Interglobe Aviation Limited. I just recently discussed that the aspect of ascertained liability and unascertained liability was discussed in the case of Interglobe Aviations, and the argument of the assessee that payees are not identified was rejected in this particular decision. So just to summarize this part of it, in the subsequent slides we will conclude on all aspects, but to summarize this part of it, if the payees are identified, so you know that who the payee is, in that cases it is better to deduct TDS, because all the decisions have gone on the basis that payees are not identified. And the second argument was that the income does not accrue in the hands of the payee. But as I said, in cases where it is other than 195, the proposition of law that income should accrue in the hands of other recipient of income may not be a proper proposition of law. So in my view, if the payees are identified, though the quantum of amount may not be identified, it would be better to deduct TDS, though it may be on estimated basis. Now, what happens to difference, we will discuss in the subsequent slides. But that would be a better proposition to accept it. As I said, chargeability to tax in terms of accrual of income, valid ground for 195 may not be a valid ground for some other provisions. The third contention of reversal on the first of subsequent years. In Subek's case, they say I'm reversing on first of subsequent years. Therefore, there is no liability to deduct TDS. Now, you could reverse on first of this subsequent years, or some cases you could also reverse on subsequently. The reversal on 1st of April or subsequent to 1st of April will really not make a difference. The question is whether on 31st of March, whether the payees were identifiable or not, whether it is a proper ascertained liability, and in those cases, whether one can say that TDS is applicable or not. Now, reversal being an accounting practice, whether that itself is sufficient to say TDS is not applicable, whether that practice itself is correct. In Biocon's decision, they discuss this aspect. They say that the old practice was you create a provision on 31st March, and suppose you get a bill in August, and at that point of time, the bill was routed through the provision account, and then the respective entries of reversal were made if required. The modern practice of reversal on 1st April, the Biocon's decision, in the view of the learned judge there, is not a proper practice, and that cannot be accepted. This is what the tribunal in Biocon's decision held. Let's again look at 201 proceedings. As I said, now the contention that if I make a disallowance under 40A, 201 is shut. That means no further action can be taken under 201. The Mumbai Tribunal Pfizer's case, a old decision in Pfizer's case, and this decision has been recently followed by Robert Bosch. This is a 2022 decision, 194 ITD 340, 194 ITD 340, Robert Bosch decision. There, in these two decisions, very clearly held that if a disallowance has been made under 40A, then 201 proceedings cannot be undertaken. If the disallowance has been made under 40A, 201 proceedings cannot be undertaken. The argument was that if the disallowance is already made, the assessee is already penalized for not deducting TDS, then subsequently the assessee cannot be again made liable for another default. There cannot be double jeopardy for the same offense. Now, this is the conclusion which has been made. As I discussed, this was not accepted in IBM's case and Biocon's case, where they said these both are different and independent proceedings. Now, all these decisions being by tribunal, one will have to naturally wait and see what high courts take a view on this. My view on this is these are independent proceedings. These are independent penal consequences for same default. There are independent penal consequences for same default. Now, yes, if the assessee subsequently discharges the taxes, by virtue of an amendment which was made to 201 few years back, then the assessee cannot be treated as default. Now, if the assessee cannot be treated as a assessee in default under 201, then the disallowance under 40A1 does not apply. So what really we need to see is, first I need to see the applicability of section 201, and then I need to see 40A1. The court in Pfizer and Robert Bosch has gone the other way around. They said if you disallow under 48, then 201 will not come into picture. My view would be that first you need to see 201 and then come to 48, saying that whether the assessee can be treated as assessee in default, whether there is a TDS default, then make a disallowances. So to that extent, I feel there is a necessity to relook at these decisions, and the interplay between these two sections should be properly appreciated. So to conclude this all discussions, I have tried to give it various situations on the left side and what could be possible outcomes under these situations. So next couple of slides will try and summarize this particular issue. First issue, payees are not identified, provision reversed in subsequent years. It should be, or actually I've written and. Payees are not identified. Now these are the cases like IDBI's case. So interest accrued but not due. But you are very clear that payees are not identified. So in these cases, 201 or 40A will not be attracted. Now, other than IDBI kind of cases, where the assessee makes a contention that payees are not identified, one will have to be cautious in terms of whether it is an ascertained liability or whether it is an unascertained liability. That naturally being seen in each individual cases, what are the factors which can help you to determine this particular cases. Factors which determine cases. If the provision is completely ad hoc and no particular pay is identified, the question of it being allowable under 37 itself would be doubtful. Then the question of 48 disallowance itself will not arise. So this is something which we'll have to be mindful of. Next, second situation, entire provision is reversed. So assessee makes in provision, an entire provision is reversed with no liability to pay the amount. So I make a provision, say for X expense, particular expense, say transport expenses, but on 1st April I reverse it and I never make a payment for those expenses. For whatever reason, that means the provision itself was incorrect. Now in these cases, naturally 201 and 40A will not be attracted, but the provision will become an uncertain liability and it will have to be disallowed. No doubt, there could be individual factors in a respective cases where we can argue that it could be allowable, but in a general sense, if you made a provision entirely reverse with no further liability to pay, in those cases, the entire provision may be disallowed. Under 37 itself. Next is payees are identified. So here I know that who are the payees. I know the estimated amount. So in my view, the TDS provisions are applicable, except maybe 195 where the income chargeable condition if not satisfied. That is again, one has to see the respective act or treaty and see whether the income is chargeable to tax or not. In those cases, one can say that the 195 is not attracted and income is not chargeable to tax. So in those cases, if one could say that even if the payees are identified, there is no liability to deduct TDS. However, in the cases where the other cases, like an example of an audit fees, I know the payee, I broadly know what will be the amount of expense. In those cases, the TDS provisions will be applicable. Now, if the TDS is done subsequently, suppose TDS is done before the due date of filing return of income or done subsequently just for simple purposes, then there will be no 201 proceedings and there will be an interest on 201 1A in those cases as held in the IBM's case and those cases. Now, just a variation of the third line item, payees are identified. Now, you know the payees are identified, but you deduct the TDS before the due date of return. Now, you make a provision of 1,000 rupees and in the subsequent month, you actually make a payment of 1,200 rupees. So I made a provision of 1,000. In the subsequent month, say in August, I made a payment of 1,200 rupees. Then what will be the consequences? Now, these are the cases where the payment is remitted before the due date of return. So 48 disallowance under 1A will not be attracted. One is a tricky issue because in case of non-resident, the situation is you should do within the due date prescribed under the Income Tax Act, not the due date of return under 139(1). However, if there are cases of non-discrimination under the treaties, those treaties, one can take the benefit of those treaties and can say that even the extended time limit of 139(1) should be applicable to non-resident payments also. That could be one of the arguments which could be taken. However, on that 1,000 rupees, the interest, because the payment has not been made in August, there cannot be 201, there cannot be 48 disallowance, but on the 1,000 rupees, that interest from whatever that period of March to the August, the interest under 201 1A will be attracted. 1A will be attracted. Next, we go to a situation where the actual payment is less than the provision amount. So I make a payment of provision of 1,000 rupees, but I actually remit 800 rupees. The interest will be on 800. The interest under 201 1A will be on 800 rupees. It cannot be on 1,000 rupees. The excess 200 rupees of provision will be disallowed in the year of provision. The next year when it reverses, you credit to P&L account, that will not be taxable in the year when you made a credit to P&L account. However, the excess amount gets disallowed in the year in which the provision has been made. Then there could be situations where TDS is not paid up to the due date of filing return of income, and it is done subsequent to actual payment. Now, these are the cases where the provision amount will be disallowed because the payees are identified. We are taking a situation where payees are identified, and in those cases, when I make a payment in subsequent years, I'll get a deduction for expenses in subsequent years. 201 may not attract because I have ultimately done a TDS in a subsequent date. Interest will be attracted, 201 1A will be attracted, but 201 1 will not be attracted. Disallowance will happen in year 1. Second year you will get the deduction for the amount. However, there will be challenges in certain cases which may arise, because if you do TDS at the year end of provisions, in those cases, what may arise in certain cases, one may have difficulties. What happens to payee? But for the payee, at least now, because the return provides for carry forward of TDS, that benefit will be available to payee. Payee has to ensure that he properly identifies those TDS line items and carry forward the amount. Then we have to, if the actual amount is less than the provision amount, so you make a TDS on 31st March itself of 1,000 rupees, but you really pay 600 rupees. Now on that excess 400 rupees, how will I get back the TDS amount? Whether I can adjust in the other returns, when I can revise the TDS return, these are all practical difficulties. There is no provision in the law. Possibly one can revise the ETDS return of those particular months and say that I will only claim 400 rupees. Possibly in the year of reversal, there will be difficulties because that challenge will be there. So the second situation here, there are no proper answers. What will be there? One will have to see what can be done in a respective case and take a proper call. So this was on the year-end provisions. Here I've tried to summarize on the year-end provisions what would be the multiple issues that will arise, both on terms of deductibility and in terms of TDS. Then we go to another interesting aspect of deductibility of expense. Three kinds of expense: interest on TDS, TDS payable, and TDS receivable. What I mean by these three kind of situations is that suppose there is a delay in payment of TDS, then I will be paying the interest on that TDS. So can I claim that interest on TDS as deductible expenditure? The issue arises here because 48(2) does not talk of interest. It only talks of tax, surcharge, and cess. So can I say interest is covered on that? That is one issue. Second issue arises is sometimes I may gross up the TDS amount. I have to pay 100 rupees, but I'm grossing it up. I pay 111 rupees, 100 to the vendor, 11 directly I remit it for the TDS. Under 195A, I gross up the amount. That excess 11, what I'm giving, whether that becomes a deductible expenditure, under what circumstances it becomes a deductible expenditure, under what circumstances it becomes a disallowable expenditure. Third, TDS receivable. That means someone has deducted TDS from me, but I do not find it in 26 years. And subsequently, I'm not able to recover this amount also from the vendor. Can I claim this as a deduction? Will it be allowable as a loss under 28? Will it be allowable under 37? Or will it be allowable as a bad debt? So these are the issues we'll try and discuss in this second aspect, or second case kind of thing which I am taking. When it comes to interest on income tax itself, it's a settled issue. Income tax, interest on income tax itself, it is a settled issue. The the Supreme Court in Bharat Commerce had long back held that the interest on income tax, sorry, not Bharat Commerce, it is Bharat Commerce. So it is long back held that the interest on income tax is not a deductible expenditure. Now the assessee made an argument in this particular case. Look at it. The income tax which I have to pay is staying with me. So it adds to my working capital. It augments my working capital. So it is like a borrowing from the government. And therefore that interest should be deductible expenditure in 36(1)(3). I should get a deduction of this. If I had not used this amount, I would have borrowed from the bank or someone, and therefore I would have paid interest on that bank. Then therefore it should be deductible expenditure. The Supreme Court in Bharat Commerce rejected this argument. They said the payable income tax is not a borrowing of the assessee to say that interest becomes deductible under 36(1)(3). In another decision, East India Pharmaceuticals Limited, the assessee borrowed money to pay the income tax. The assessee borrowed money to pay the income tax. And on that borrowed money, it paid the interest. The question was that on that borrowed loan, whether which has been taken specifically identifiable for the purpose of paying the income tax, can I say it is a deductible expenditure? The Supreme Court in East India Pharmaceuticals said 224 ITS 672 said that even if it is borrowed money, you cannot claim that interest as a deductible expenditure, because borrowing is not for the purpose of business, it is for the purpose of paying income tax. Therefore, you don't get a deduction for interest on that borrowed money, the borrowing which is taken for payment of interest. So these issues basically got settled with the Supreme Courts, that anything to do with income tax payment, interest on income tax, or interest on a borrowing which is taken to pay the income tax is not a deductible expenditure. Now, when it comes to TDS, the issue becomes slightly different. And one of the main contention is that interest on TDS is compensatory. Now, look at TDS. Is it my income tax? It is not my income tax. It is the income tax of the third party. A statutory liability has been cast on me. A statutory liability has been cast on me to provide for deducting TDS and discharging the payment to the government. It is a statutory obligation. It is not my income tax. TDS interest, any interest for that matter, is compensatory in nature, and any compensatory interest should be allowable as deduction. Is the arguments which assessee made. That's the arguments which the assessee made. When it comes to interest being compensatory in nature, this is also a settled issue based on various decisions, Prakash Cotton, Ahmedabad Cotton. Some of these decisions are in the context of indirect taxes, where if the assessee has a delay in payment of, say, a GST, and interest on that GST becomes a deductible expenditure. Broadly settled by various decisions, Ahmedabad Cotton, Prakash Cotton, that this interest is a compensatory in nature, it is not a penal in nature, and it should be allowable as expenditure. Even the new explanations added to 37, Sudhindra would have possibly discussed this, the new explanation 3, which says compounding fee will not be a deductible expenditure, but interest is still a compensatory in nature, it is not a compounding fee, and that should still be available as a deduction. So the restriction in explanation 3 is explanation 3 which explains the explanation 1. So explanation 1 says any fine etc paid for an offense or something which is barred by law, and explanation 3 explains that explanation 1 saying that offense made under foreign law is also covered, payment to professionals which is barred by some rules regulation is also covered, and third, the compounding fee is also covered, so that also becomes a disallowable expenditure, right? So then the argument was whether this is an interest is compensatory and interest on TDS should be allowable. So this was the argument taken in the case of Premier Irrigation LD Tech. Before going to this, I will take a favorable decision. Now, Narayani Ispat, what was the issue was, is an old decision at Calcutta Tribunal. The first decision what we discussed, Premier, Actually, it does not refer to Narayani Ispat. There is no discussion on Narayani Ispat, though both these decisions being of a Calcutta bench. Now here the question was two things. One was interest on delay in making payment of service tax and delay in making payment of TDS. The tribunal took a view that these both are compensatory in nature. These both are compensatory in nature and they are not in the nature of penalty. They are not in the nature of penalty. And therefore, the interest on late payment of TDS related is allowable expenditure. So this was something which held in favor of the assessee, and TDS is not a tax of the pay. So therefore, there is no question of disallowing it. Now, the Premier Irrigation Agritech, here the tribunal did not follow Narayani Ispat, though being of same tribunal, coordinate bench. The tribunal said that the question whether interest is TDS, the assessee naturally argued on 40A, saying that look at 48.2, it talks of income tax surcharge and says it doesn't talk of interest. So interest is not covered in 48. The assessee said don't go to 48. The tribunal said that don't go to 48.2 first. First you look at whether it is a deductible expenditure under 37. So under 37, an expense is allowable if it is incurred wholly exclusively for the purpose of business. So the question is whether a TDS is interest on TDS, is it incurred wholly and exclusively for the purpose of business to be claimed as deductible under 37. Naturally, it is not capital in nature, it is not penal in nature, it is not personal in nature. Those tests are satisfied. But the test that really needs to be seen is whether it is incurred wholly and exclusively for the purpose of business. Now keep it in mind that interest on TDS, the TDS obligation naturally arises during the course of business. If I make a payment of professional fees in the course of business, I have a liability to deduct TDS. It arises on the course of the business. Now, can you say something which arises in the course of the business is for the purpose of the business? So is there a distinction between arising in the course of the business or arising for the purpose of the business? The decision in the subsequent decision also, the expat engineering, I'll come to that. So there they discuss these aspects. They say you cannot say that interest on delay in payment of TDS is for the purpose of the business. It may be in the course of the business. The obligation springs from the business, but it is not liable. It is not for the purpose of business. Now, same view was taken in expat engineering's case. Expat engineering is Bangalore Terminal 149 taxman.com 451. A very detailed decision, a very good decision, detailed written. This again in detail examines section 37 and say that what you really needs to see is section 37. Assessee argued on 48.2. That says 48.2 is not an enabling section, it is a disabling section. So first, if the expense is allowable under 37, you really go into 48.2. So you can't look at section 40 as an allowability section. It is a disallowability section. That means something has to be disallowed. And for something to be disallowed, it should be first be allowable under 28 to 37. It should be allowable under 28 to 37. As we all know, 28 is a charging section for business heads. Computation is done. The 29 provides that deductibility based on 30 to 37. Expenses which are deducted are to be deducted under 30 to 37. So if something is allowable, then you look at disallowance sections of 48. Straight away, don't jump to 40A and look at this particular proposition of law. So expat engineering, Chennai Properties, Sri Saras Spice Foods, Royal Packaging, all have taken a view that it is not allowable under 37, and therefore it is not deductible expenditure. So if we look at from the point of view of 37, the decisions which take a view that it is not an allowable expenditure, appear to be correct, because you can't say that interest on delay in payment of TDS is incurred for the purpose of business. It has to be, the section says it should be incurred wholly exclusively for the purpose of business, and it is not incurred wholly exclusively for the purpose. It is incurred in the course of business. But another point, an interesting point, which can be taken if tomorrow some litigation comes up, not for the purpose of planning, is whether it is a loss under section 28. It is not something which I have to go to 37. It is a loss in the case of 37. It is incidental to me doing a loss. We will discuss that when we go to the next case of Mahindra and Mahindra. A very interesting two next decisions we will see. And in those cases, we will see whether what can happen if there is a loss. How do you claim a loss under section 28? Badridas Daga's decision, the classic decision on this particular aspect. We'll try and analyze that. So that could be one proposition which could be there, but possibly this view now gets settled by various tribunal and Madras High Court's decision in Chennai Properties 239 435. It is going to be very difficult for us to say that it becomes a deductible expenditure. Let's move on to related issues. Another issue that generally arises. Maybe I'll take the next slide first and come back to this slide. Yeah. So now we talk of interest on TDS. Now let's talk of TDS itself. Now there could be situations where the assessee bears the TDS. It could arise in multiple circumstances. In non-resident payments, it is very normal for us to understand, for normals to see that assessee has to gross up the TDS and pay TDS out of his own pocket. So the payment is 1,000 rupees, 110 is TDS. Then that excess amount I pay out of my pocket. Now this excess amount, what is the character of this excess amount? Some interesting decisions on this. We will throw light of change at what position one should take on the TDS payable itself, that the assessee has to cross it up from his side and pay to the vendor and discharge the he pays the entire amount to the vendor and discharge the TDS out of his own pocket. Whether that amount which is discharges out of his own pocket becomes a deductible expenditure. This also can arise many times at a practical situation. Suppose there is a professional fees bill of 50,000 rupees. By mistake, you have not deducted TDS. The accountant has made a mistake or the owner has made a mistake. He remits the 50,000 rupees. Subsequently, while doing the tax audit, you realize that, look, he has to pay 5,000 rupees of TDS also. Otherwise, this 50,000 gets disallowed. So then 5,000 is paid out of pocket. Now, if you have good relation with that particular vendor, you may get back that 5,000 rupees. Otherwise, you pay that 5,000 rupees out of your own pocket. This especially happens where the TDS rate is 1%. So you make it, say you have 1 crore of contractor payment. Now you have disallowance of 1 crore rupees. To save that disallowance, you will make a payment of 1 lakh rupees of TDS. Right? So you do a cost benefit analysis, realize that it is better to pay off this 1 lakh rupees and claim the deduction for the expenditure. Otherwise, my expense will be disallowed to the extent of 30% under 40A1. So therefore, the assessees may make a payment out of their own pocket. Now, how does this work? Can we say that this becomes a deductible expenditure? Can I say this is a deductible expenditure? We'll discuss some of the decisions in these particular cases. Now, keep it in mind that most of these decisions are case of NR payment, but that doesn't make a difference. We can apply the principles in this particular cases. In the case of Lit on Mobile India Private Limited, the assessee had taken a certain borrowing from its associated enterprise. Now, keep this first case facts in mind. It is taken from the associated enterprise. It took a loan from the associated enterprise, and as per the terms of agreement, the loan agreement, the assessee had a right, the Lit on Mobile had a right to deduct TDS and remit the net amount. However, despite there being a right available to remit the net amount, the assessee grossed up the payment. Instead of reducing it from the payment made to pay, it discharged the TDS from its own pocket. The tribunal said the assessee has followed crossing up of interest, which is contrary to agreement between the parties, and the parties associated enterprise here, and therefore the TDS, which is extra payment which is the assessee has made, TDS which is paid out of his own pocket, is not an allowable expenditure. In contrast, the decision of Bob Cards 29taxman.com 234. There, the assessee had made certain payments to MasterCard and Visa for certain services, and as per the agreement, it had to gross up the amount. So the grossed up amount was discharged. Now, question was whether this grossed up amount becomes a deductible expenditure in the hands of the assessee. The Mumbai Tribunal held that in a recent decision that it is a deductible expenditure. The difference between Lit on Mobile and Bob Cards is in the Bob Cards, the payment was crossed up as per the agreement. In Lit on Mobile, there was no provision in the agreement to cross up the amount. and it was a payment to an associated enterprise related party, the tribunal took a view in the Liton Mobile that it is not a deductible expenditure. In the Bob card, it took a view that it is a deductible expenditure. So they've gone by the terms of agreement, that whether your payment to the vendor is as per the terms of agreement, and based on that they've applied the principle and gave the deduction. So one will have to be very careful. One will have to be very careful that whether one drafts the agreement, he has to take care that if it is a gross up kind of situation, agreement should clearly specify it is a gross up kind of situation. If the assessee has a right to deduct TDS, it is better to deduct TDS and not gross it. So otherwise, these decision of letter on mobile can come in way of it claiming in deductible expenditure. A better decision, a good decision is also of a Madras High Court in standard polygraphy 243 ITR 788. Now, in this case, the assessee had made payment for certain technical know-how. Now, on this technical know-how, it had to deduct TDS as royalty, and it did not deduct TDS, it grossed up the TDS. Now, the technical know-how for a capital in nature, for a plant, it was taken, and that was capitalized. The assessee also capitalized the TDS amount under 43.1. The assessor said it is also an actual cost of the plant for the purpose of 43.1, and therefore it should be capitalized and depreciation should be allowable. The assessing officer disallowed the depreciation. The Madras High Court said that based on the agreement, it is very clear that the assessee had to cross up the amount, and therefore we allow the TDS to be taken as a gross up and to be part of the capital asset and becomes a actual cost under 43.1 and claim a depreciation on that. So it's again a favorable decision. This decision has been followed by Mumbai Tribunal in Man Industries 147 taxman.com 178. So to summarize, the principle emerging from these decision is take care of the agreement, take care of the terms of agreement, and see whether the agreement provides for crossing up. If it is so, one can claim the deduction of that extra TDS, applying the principles laid down in this decision. However, also one should note that in a local payments, the example I gave, suppose I make a payment of 50,000, the owner forgets to deduct TDS, and subsequently he realizes that I have to do TDS of, say, it is 1 crore rupees and 1 lakh of 194C I have to do. Now the assessee pays this 194C out of this. Now where is the agreement in those cases? These all decision talk of agreement. Where is the agreement in these cases? Now in these cases, the better approach will be to first show that 1 lakh rupees as receivable from that vendor. To show that 1 lakh rupees is receivable from the vendor. Then make a claim with that vendor that, look, I have remitted TDS on your behalf. This is the certificate of that. Kindly give me 1 lakh rupees. If he gives you 1 lakh rupees, nothing like that, you don't have any expenditure. If it does not give you an expenditure, then write off that 1 lakh rupees as bad debt. Write off that 1 lakh rupees as bad debt. If one follows this procedure, the amount will be written off as bad debt. In my view, that it becomes a deductible expenditure. It becomes a deductible expenditure. But it is very necessary that proper accounting entries are done. A claim is made to the vendor that, look, I have asked you to give, I have remitted TDS on your behalf, so kindly give me 1 lakh rupees. The EO will have to the vendor will have to either say is giving or is not giving, and then you write it off. Then it becomes helpful to claim this thing. Claim it is an expenditure. Now let me look at TDS receivable, the other way around. What could happen is, as we all know, when we get the professional fees, for example, I get 1 lakh rupees of professional fee, 10,000 of TDS is deducted. Now, in 26 years, this may not be appearing. In 26 years, this may not be appearing. I will make a claim for this 10,000 rupees in 26 years. But the situation me that CPC, as we all know, disallows this 10,000 rupees and does not give me TDS credit. Now, if the amounts are small, generally most of us will not follow up for that 10,000 rupees, though as per the law, once the TDS is deducted, credit should be given to me. That is a settled principle of law, because the revenue has to recover it from the payer, not recover it from payee. But anyway, there could be situations where due to smallness of amount or various other circumstances, one is not able to follow up for this. And he says this 10,000 rupees I am writing off in my books of account as TDS receivable or whatever. In those cases, various decisions have discussed this aspect. Shreyans Industries is the old decision. And then we have Kelly Services, we have Indian Products, we have Yahoo Web Services, and Expo Freights decision, Madras High Court, Madras Tribunal decisions. all of these have held that it is a deductible expenditure. Especially the export freight decisions very clearly, and it's a more proper decision because it says, look at this, the associate did not get the TDS certificate, in TDS is written off. It is not, and the payer did not remit this amount to the government account. The assessee has no certificate of it. The assessee's credit is not available. The CPC has not given the credit for this. And in those cases, it becomes bad debt because it is an amount receivable from the customer. So I provided him the services. I have to receive 1 lakh rupees. He gives me 90,000 in check. 10,000 he has to give me in a TDS form. He doesn't give in the 10,000 rupees. So it becomes a bad debt and allowable under 36(1)(7). So in my view, it is more of a bad debt rather to say that I'm writing off as a TDS receivable. So the nomenclature really does not make a difference. It is a receivable. It is a debt which is receivable, and that I'm not able to get, and therefore it becomes a deductible expenditure. These are the decisions on the aspect of interest on TDS, TDS payable, TDS receivable. Then we will go into certain interesting questions of understanding section 28, a recent decision of Bombay High Court in 150 taxman.com 332. The question is a very interesting, the fact pattern is very interesting. It's an old decision, goes back to 1809. Possibly Bombay High Court took 20 years to decide it, but as it may be, but it's a very interesting proposition of law. This decision and the next decision in Prakash Chandra Lunia's case, Supreme Court's decision, are on the question of loss. How do you claim a loss? If you see the provisions of section 28, they go back to section 10 of 1922 Act, section 10 of 1922 Act, and section 10, very similar. 28 was section 10(1) of 1922 Act, and we had section 37, which is currently 10 to 15 of the old Act, 10 to 15 of the old Act. So these decisions, both these decisions discuss the concept of loss vis-a-vis expenditure and under what circumstances the loss becomes deductible, right? So let's capture the facts first, and then we will go to the findings of the tribunal, findings of the High Court. The assessee M&M, Mahindra and Mahindra, held 27% in MMC. MMC is Machinery Manufacturer Corporation Limited. The MMC's main activity was manufacturing of textile industry. The textile industry, as we all know, did very well in the beginning up to 84, and it made good profits. Subsequently, there was a recession in textile industry, new technology and a lot of changes happened, and therefore the textile industry was not doing well. And naturally, when the textile industry is not doing well, a company which manufactures the machinery for textile industry will also not do well, and it started making huge losses. A rehabilitation scheme for MMC was worked out with IDBI, where IDBI would have given a loan of certain amounts, 2 crore rupees, but Mahindra and Mahindra has to give corporate guarantee for those 2 loans. And also M&M had to contribute directly to the funding of MMC. So based on this rehabilitation package, the M&M started giving funds to MMC. However, for various reasons, the scheme failed and MMC could not be revived, and it continued losses, and it was referred to BIFR under the Sikh Industrial Companies Act, Board of Industrial Finance Reconstruction. So it ceased its operations and there was no business activity. It ceased its operations. There was no business activity. So the total dues were 6.22 crores, which it funded the MMC based on rehabilitation package and some other earlier receivables. During the suspension of operations, it also paid the salary and other expenses of the staff, etc. Though the company has ceased operations, naturally it has some expenses, basic expenses are there. So M&M incurred those expenses of MMC and claimed those expenditures. In 89-90 assessment year, assessee claimed 6.22 crores as deduction and also 42.89 as a deduction. Both these expenses were claimed as a deduction. The claim was made under section 28 that it is a loss. It is a loss. It is not an expense. It is a loss. and the claim was made under section 28. Revenue naturally disallowed it. CIT upheld the assessment order. Tribunal findings are very important, very interesting findings. Tribunal says that if such an addition, also upheld the addition with an observation that if assessee's contention regarding safeguarding good name and reputation through cash grants to group companies accepted, most of the companies under the umbrella of one group management can so arrange their affair that loss of one company is set off against the profit of another. What the associate argued before the tribunal is, look, I am M&M, I have a goodwill, I have a good name, and this is a group company, my group company. And if my group company is making a loss, if its name gets spoiled in the market, my name also will get spoiled in the market. So it is connected to me. It is like my subsidiary, my son. So if his name is spoiled, my name is also going to get spoiled. So protect my goodwill. I am in reputation. I am making these expenditure, and therefore there is a commercial prudence in claiming this expenditure. There is justification for claiming these expenses, and therefore claiming the loss, and therefore claim this loss. The tribunal said that this is not permitted. If this be permitted, the losses of anyone who in the group will do the same thing. They will fund the loss making expenses and claim the loss in the company which is funding it, saying that it is the obligation of parent to safeguard the good name and reputation. So tribunal rejected it. So broadly, there is 3 points under which the disallowance has been made and which has been dealt by the High Court. That there is no principle of accountancy or law where to allow an expenditure incurred to meet the liability of another company, or for the debts of the another company, debts written off in the books. So there is no principle of accountancy or law to claim this expenditure. The monies lent or expense incurred by appellant was not the business loss incurred by the appellant, or business loss incurred by the appellant was not the business loss incurred by the appellant in the course of its business. It is not in the course of the business, and therefore not allowable while computing the income of the appellant under the heads profits and gain, business or profession. There is no commercial expediency for appellant to protect the assets of MMC, and therefore there is no need to lend to MMC. Also, the assessee held 27%, and no other shareholder came to protect the loss. It is only the assessee who came to protect the loss, to protect the MMC. Okay. Now, what does the High Court hold? And these two observations are very interesting and very important. And we all also see the application of Badridas Daga, the classic decision 34 IDR, the old decision under section 10 of the old Act, 1922 Act. Now, what the High Court held is section 30-37 provide for deduction from total receipts to compute profits and gains of business or profession. However, they do not. The Act, however, does not provide the deduction available from the total receipts to compute profit, and are only those deductions which are listed in section 30-37. The list is not exhaustive. That means the expenses given in 30-37 are not exhaustive. This is not exhaustive. The assessee can go beyond this also. Any loss which occurs in carrying on the business related to business operation is entitled to be deducted on the gains to arrive at profits and gains under section 28 itself. For coming to this conclusion that the loss is deductible under section 28 itself, you do not go to 30-37. The Bombay High Court relied on the earlier decision of Bombay High Court in Harshad J. Choksey. What does it say? Section 28 of the Act imposes a charge on profits and gains of business or profession. The expression profits and gains of business or profession is to be understood in its ordinary commercial meaning, and the same does not mean total receipts. So the profits and the expression profits and gains of business or profession, it does not mean total receipts. It means net receipts. What has to be brought to tax is the net amount earned by carrying on the profession. Net amount earned by carrying on the profession. Please note down this. That's what the principle is. Business which necessarily require deducting expenses or losses incurred in carrying on the business or profession. For coming to this conclusion, the Supreme Court relied on the decision. The Bombay High Court relied on the Supreme Court decision in Badridas Daga, where it was held that the assessing the amounts of profits or gains liable to tax, one must necessarily have regard to accepted commercial practice that the deduction of such expense losses is to be allowed if it arises in carrying on the business and incidental to it. So any loss which is incidental to carrying on business if it arises in carrying on the business, it is allowable expenditure. Now, what did Badridas Daga say? Badridas Daga was a case where there was an employee and he was carrying money of the assessee, some 2 lakh rupees, a princely sum in those days. It is some 1959's decision, a large amount in that mean. The employee, and there was a theft by the employee, the money was lost. No doubt they made a police complaint, tried to recover, nothing happened. The assessee claimed that deduction as a loss, saying that, look, the money, this is in the course of the business and it should be allowed as a deduction. The claim was on 3 counts. The claim was on under three arguments. One, that it is an expenditure like 37(1) incurred for the purpose of business. Is it an expenditure? Is it a bad debt? 36(1)(7), as we discussed in the earlier slides. 37 expenditure. If it is not both, at least give me in section 28. The corresponding sections of the old law was section 10(1), 10(2)(11), and 10(2)(15). So under the 1922 Act, this claim was made. The Supreme Court said it cannot be an expenditure. It is not an expenditure. You don't incur for anything. It is naturally not a debt because it is not something which is receivable from the employee. You make the payment. But they said it is a loss which is incidental. And for that, they made an observation that it is accepted commercial practice. The deduction of such expenses and losses is to be allowed if it arises in the carrying on business and incidental to it. So the main thing was the losses should be incidental to it. It should arise in the course of business and when the assessee is carrying on the business. They also make an observation. The Badridas Daga's case makes an observation. If there is a theft in the home, then that cannot be something which is a deductible expenditure. They also say theft in the shop at night cannot be a deductible expenditure. No doubt that particular observation has been watered down in subsequent decision of Pyara Singh's case by the Supreme Court. So they said that that is not seen. What are they saying is it should be carrying on the business and incidental to it. If this test is satisfied, Badridas Daga's case, then that cases those losses will be deductible expenditure. The force of assessee's argument in M&M was that I have incurred this debt and this miscellaneous expenses in the course of carrying on the business and it is incidental to it. How is it incidental? That look, it is an MMC, it is my group company. If I do not support it, my name will be spoiled, my reputation will be spoiled, and it will spoil my name in all vendors, customers, etc., etc. My name will be spoiled. So there is a nexus between my carrying on business and MMC's carrying on business, and therefore it should be allowed in expenditure. The High Court accepted this argument. That MMC was viewed as a Mahindra Group company, and appellant thought it fit to preserve and protect the goodwill attached to its name by the business community, consumers, employee, financial institutions. It cannot be disputed that MMC was part of appellant group. This was accepted in BIFR order, and there was no dispute that the MMC was part of appellant group, despite the fact that it held only 27%. There were other shareholders. But they said, despite that, MMC is a part of Mahindra Group. It is part of Mahindra Group. So therefore, based on commercial expediency, then we are saying that this should be a deductible expenditure and it cannot be dismissed. The assessee's contention cannot be dismissed. It had to give the debt to the group company. It had to bear its expenses of employees and security charges, etc. It cannot be there. It is not disputed that there exists a nexus between appellant and MMC. Between the appellant and MNC, and expenditure should be treated for incurred for the purpose of business and related to business of the appellant, thus eligible for deduction. Otherwise, the profit will not reflect the true profits and gains of the appellant. So, no other. Though no other shareholders contributed, the deduction was given to MMC because it was an MMC group, Mahindra and Mahindra group company. MMC was a Mahindra and Mahindra group companies. No doubt this decision will go to Supreme Court and we'll have to have a final word from the Supreme Court. But if this decision is confirmed by the Supreme Court, look at the possibility of claiming an expenditure under Section 28. I have a group company, I have a sister company which is making losses and I fund those losses. It is possible for me to claim those expenditure because on overall basis, it is my company and my goodwill which is attached to it. So preserve a goodwill, protect a goodwill, preserve my good name in community, business community, consumers, employee, financial institutions, etc. They have said that this itself is a commercial expediency. This itself is a commercial expediency. It's a good case for me to claim this deduction. So this is what the decision of Mahindra and Mahindra is, right? A similar, not a similar one, but a slightly important one. We have a limited time, but anyway, we'll briefly look at it. I have to wind up by 6, but maybe next 10 minutes I will just look at this decision and close it. A recent decision of Prakash Chand Lunia, 454 ITS 61, 454 ITS 61. Now here the assessee was engaged in the business of purchase and sale of silver, and a search was conducted in the business premises of the assessee, and silver slabs and ingots were recovered by DRI. The collector of customs ordered confiscation of this in unaccounted slabs. That's the case was of a smuggling. Certain personal penalties were also levied on Prakash Chand Lunia, and certain arrests were also made. Now, whether the silver which was found, now the assessing officer said the source of the silver has not been explained. Therefore, he made an addition under 69 capital A. He made an addition under 69 capital A. Right? The commissioner confirmed it. The tribunal confirmed it. Before the High Court, the contention was whether, yes, if 69A, whether I am the owner of that 69A, and therefore the 69A, one of the tests is you should be owner of that particular asset. It's a valuable article or thing. So whether I am the owner of that particular asset. That was one argument. Second, if the 69A is taxable, give me a loss for confiscation of silver by the custom authorities. Because they have confiscated my stock, it becomes a loss, and deduction should be given under 28 to me for this loss. The High Court accepted the contention of loss on confiscation following the Pyara Singh's case. So Pyara Singh's case was some smuggling activity was undertaken, and those notes, smuggled notes, were confiscated. So he was into the business of smuggling notes and doing other smuggling activities. So on that confiscation, the Supreme Court had held that loss on that confiscation of smuggled articles or smuggled currency in that case is an allowable expenditure. So applying the principle laid down by Pyara Singh's case, the High Court allowed the deduction to the assessee on the confiscated silver. The revenue filed an appeal to the Supreme Court. Supreme Court has gone haywire on this particular decision. There are two decisions, one by Justice M.R. Shah in the first part of the decision. Second, there is a concurring decision of Justice Sundaresh. Now, Justice Sundaresh says, I agree with the decision of M.R. Shah, and he lays down his own reasoning why he agrees. And that reasoning is completely different from the reasoning given by the M.R. Shah in the main decision. Now, M.R. Shah doesn't say that Justice M.R. Shah doesn't say he agrees with the views given by the Justice Sundaresh. So what is the value of precedent value of Justice Sundaresh's decision is a point of an issue which will have to be debated. But apart from that, what I really said, the Supreme Court makes a distinction. The M.R. Shah's decision make a distinction between an illegal business per se and a legal business in that illegal activity. So the assessee's business in Prakash Chand Lunia's case is a legal business. It is doing business of trading in silver, right? And in that legal business, it does one activity which is illegal, right? Of smuggling silver slabs. Whereas the decision of Pyara Singh was per se illegal because he was doing smuggling of notes and counterfeits and etc., which the business itself was illegal. The Supreme Court says that Pyara Singh's decision was in the context of an illegal business and a loss in illegal business, and therefore it is allowable, was correct. But the Pyara Singh's decision is not applicable to Prakash Chand Lunia's case because here it is a legal business in which there is illegality. So High Court erred in following Pyara Singh's decision, and the loss cannot be deductible expenditure. It doesn't fit into the overall scheme. The decision of Supreme Court doesn't fit into the overall scheme for the reason that if it is illegal business, you are giving a deduction. For the legal business also, what is the section 28 to 37 really does not make a distinction between a illegal business and legal business. Only explanation 1 to section 37 makes this distinction, that if you incur an expense or a fine for the purpose of which is contrary to law, in that cases that expenditure will not be allowable. Very correct principle, as the explanation lays down that guidelines. So if I claim an expenditure which is illegal for an illegality, then it is not to be allowed, because the explanation 1 to 37 provides it, further amplified by explanation 2 to 3 to section 37. But when I'm claiming a loss under 28, then whether the explanation to 37 will also attract to section 28 is not provided in the act. But in the decision of Justice Sundaresh, he goes on to discard the distinction between loss and expenditure and say that loss and expenditure are similar, and applies the Badridas Daga's decision in a different context, in a different way, and then comes to a conclusion that loss and expenditure are not different, and therefore the explanation to 37(1) will also be applicable to loss, and therefore it should be disallowed. The other part of decision also discusses section 115 BBE. Now 115 BBE, as you all know, provides for 60% tax rate, and I mean this decision is the cases of 80 and 90. At that point of time, even 115 BBE was not even applicable. But anyway, they discuss 115 BBE and say that 115 BBE for the purpose of tax rates provides that no set-off of loss is permitted. And reading that words, that no set-off of loss is permitted, they say that this set-off of loss also restricts the loss under 28, without appreciating that the set-off of loss referred in section 115 BBE is with respect to intra-head and inter-head set-off under section 70-71 onwards. It is not the loss which I claim under section 28, but still that they refer to 115 BBE and make that conclusion. They say that the penalty or confiscation is proceeding in rem. It is against the goods, not proceeding in personam, and therefore it is not, same is not available for deduction regardless of the nature of business, as a penalty confiscation cannot be said incidental to any business. They said penalty or confiscation can never be said incidental to any business. So the second part of Justice Sundaresh decisions goes into a different dimension and discards the distinction between loss and expenditure, which is a settled decision by various larger bench decisions, like the Badridas Daga's case, the decision of Woodward Governor, the decision of Apex Laboratories. All these decisions have time and again accepted that loss is different from expense. These aspects are not properly discussed in the decision. But anyway, this is how the decision has gone about. So I've just briefly covered it because of shortage of time. Deepak, we can take any questions if we have. I think some questions.
There are a couple, sir, in the Q&A box. I'll just read it out for you. Which are the penal charges levied under any statute qualifies as incurred for business purpose?
Now, see the penal charges. Which are the penal charges levied under any statute qualifies incurred for the purpose of business? Now, for example, the distinction between penal charges and the compounding offense or compensatory charges is what we have to understand. So in cases where the offenses or the charges were compensatory in nature, the courts have always taken a view that in those cases, the reduction of expense will be available. Now, penal charges, if they are for the purpose of section 37, the explanation itself says that they are not incurred for the purpose of business and it will be disallowed. So the explanation 1 to 37 itself now provides that they are not incurred for the purpose of business. Before explanation 37 was there, applying the principle laid down in Pyara Singh's case, a view was taken that this would be a deductible expenditure. But explanation 1, further amplified by explanation 3 to section 37, if it is a penal charges under any statute, and now even under foreign statute, in those cases it will not qualify as a deduction, right? Yeah. Go to next question.
Suppose TDS is not deducted, can such expenditure be claimed under Section 28 to avoid 40A1A disallowance?
Now, first question is, if it is an expenditure, the question is whether it is covered under 30 to 37. Now, if it is something which is covered under 30 to 37, then I can't come to 28, because 29 would be say that the computation has to be done as per 30 to 37. Now, once it is specifically covered under 30 to 37, I cannot come under 28. 28 would cover a situation applying the principle laid down by Badridas Daga's case 34 idea, where it is incidental to business or arising in the course of business. So in those cases, if it is, for example, a loss or something else, then it will come under 28. Right? Now, let me look at the language of 48, whether it will cover 28. 40 covers only 30 to 38. It doesn't cover 28. So in the cases where the claim is under 28, in those cases, possible to say that the principle laid down under 40A will not be applicable. But the point should be noted that if it is a specific expense which is covered under 30 to 37, in those cases I can't go to.
So just an extension to this question, can I say that my purchases is a deduction that I claim under Section 28 and not under 30 to 37, and thereby avoid disallowance under 40A1A for not doing TDS under 194Q?
So for purchases, there is no specific section. So there is none of those sections would say that I will give you deduction for purchase of goods. I'll give deduction for purchase of goods. So possible to say that the claim of these expenses is being made under 28. Now the next question will be whether the claim is under 37 or 28, right? Because 37 being a residual category. So whether for purchases 37 is more apt or 28 is more apt, right? So 37 would say any expenditure laid out or incurred for the purpose of business. Now, is a purchase an expenditure incurred or laid out for the purpose of business? The answer would be yes, because it is falling within the term of 37. Now, if it doesn't fall, if it is not in the nature of expenditure, where I can claim it as a loss under 28, the distinction of expenditure and loss has to be kept in mind. The losses will come under 28, but the expenditures will come under 37. And that is what we'll have to keep it in mind. So because otherwise what would happen is even 37 conditions are not satisfied, because it's a capital expenditure. Can I say I will come back to 28? You can't come back to 28. So if it falls in 30 to 37, you really will not be able to come back to 28. Okay.
I think that's all that we have in the Q&A
First
box.
question, I think, is there any TDS default in case the year-end provisions which are not made by error, full or part? The question is not very clear, but I think in my table covers various circumstances of that aspect.
A connected question which quite often comes up is if there is a short deduction. I had to do a 10% and I've done a 2% rate deduction. Should there still be a disallowance under 40A1A?
There are various tribunal decisions which have taken a view that short deduction is not covered under 40A1A. I think Tekriwal's case and quite few decisions have consistently taken a view that short deduction is not covered under 40A1A. So one can take a benefit of those decisions and take a view that in case of short deduction, disallowance under 40A is not applicable. In my personal opinion, those decisions may not be completely correct. A proportionate disallowance may be more appropriate. But anyway, as I said, there are decisions which have taken this view. One can take a benefit of those decisions.
There's one more which has just come up.
Yeah.
Suppose TDS is not deducted, but expenditure is also not claimed. Whether disallowance can be made when it is claimed?
No, question is suppose now expenditure itself is not claimed. So I mean again, should be more important here. So in year one, let's say situation I have not claimed the expenditure. I have not claimed the expenditure. So once I have not claimed the expenditure under 37, question of disallowance under 40 will not arise, because there cannot be double disallowance. There is 100 rupees of P&L debit, say 1000 rupees P&L debit for X or Y item of expenditure. So I have not claimed, I have disallowed this for some other reason. Say I have disallowed this as a personal expenditure. In that case, the question of again disallowance under 40A will not arise. So if I'm not claimed an expenditure, then I will also not say that the disallowance should be applicable. The second line of this question says whether what will happen if the disallowance can be made when it is claimed. So the assessee is possibly visualizing a situation that in second or third year, if I claim it again. Now the question is under what context you have deferred it, in what context you have deferred it, and the context could be whatever everyone has deferred. So when I defer it in second year, I have really claimed an expenditure under 30 to 38 under the head profits and gains of business or profession. Section 40A beginning limb of section 40A very clearly says that you have claimed any expenditure under 30 to 38 under the head profits and gains of business or profession. So in year 2 or year 3, when I really make a claim of this particular expenditure, so in year 1 I have deferred it, in year 2 or year 3 I claim it. At that year, I will have to see whether TDS compliance is done or not. If TDS compliance is not done, in the year 2 or year 3, the disallowance will be attracted.
One practical case that I could think of in case of this deferral is, let's say in the month of March, I bought a software on which I was required to do TDS. In my books, I have booked it as a prepaid expenditure. It's a licensing arrangement which starts from April next year.
Yes.
And I'm claiming the expenditure in year 2, but booking the purchase in year 1.
Yes. Now, there could be prepaid expenses like what you are saying. There could be many more, not just software. Now, the question will be is when I made a payment in March, so whether I deducted TDS or not, or if TDS was applicable. Now, if I'm not done in TDS in March, in the year of March, there may not be any disallowance, because in that year, I have not really claimed any expenditure, right? But in the next subsequent year, when I claim this expenditure, the test of 40A1A or 40A1 may still have to be applied in those cases in the second year or third year, whatever it may.
Right, sir. I think this is all that we have in the Q&A box. With the permission, we'll conclude this.
Yeah.
And I take this opportunity to extend our formal vote of thanks to our speaker,
Thank
Narendra
you,
sir.
KSCA, and thank you, Deepak, and all KSCA office bearers for giving me this opportunity of presenting my views on certain important case laws. It's a great learning experience for me also. Thank you, one and all, for patient hearing. Yeah, Deepak.
Thank you, sir, for having consented for our program and having devoted your time. And we also thank the attendees for their participation. Thank you all. The session stands concluded.